can you buy a property when you already own an existing one? Are you looking to upgrade or downgrade? Well, today we've got everything you need to know from bridging to simultaneous settlement and more. So stick around and we'll dive right in.
So picture this, you bought a home 2 years ago, it was the perfect first home, but suddenly you're growing out of space and you need to potentially buy and sell a home at the same time because you can't do bridging. This is sometimes called a simultaneous settlement, and it's really common at the moment, especially in a rising market where property prices have gone up a bit. So in this video, we're going to step you through some of the pros and cons and how you can buy and sell a home at the same time.
All right, so some things to consider before we look at any of these options. I guess there's a few things. The first is how quick you can potentially sell your home. Is it going to take months to sell? Is it in an area that's going to sell really quickly? The second is how long it's going to take you to find the next property. So you've got a place you're already living in. Are you comfortable? Are you looking for something very specific? Is that going to take you a long time to find the next property of your dreams? The third is, can you get any financial support from family or friends like guarantor loans or even borrowing some money for a short period of time? The fourth is asking yourself how much equity you have in your home, because then you can look at things like bridging finance. And the last is understanding your borrowing capability, and if you do have an ability to hold on to the property that you currently own, as well as buying another property at the same time. So today, we're going to walk through all these steps, and depending on how you answer this question, you will have a solution that will work for you.
All right, so let's start with how easy it might be to sell your home. Now, if you're not sure about the market conditions where you currently live, it's probably best to have a quick chat to a real estate agent. They're always happy to give you an appraisal on your home and tell you how much they can sell your house for and potentially how quickly they can do it in. You definitely want to have a pretty frank conversation with them and say, well, potentially I'm going to be buying a new home, upgrading the same market. Do you think it's reasonable to sell my house in 30 days, 60 days, 90 days, 6 months? How quick are properties turning over in my suburb? If they say it's a bit of a sluggish market and it's going to take 6 months, you need to take this into consideration, because if you've signed a new contract on a new home, you need your old home to settle at the same time or before you move into the new home. The other downside with selling first is you might end up selling your house really quickly, having to move out and move twice because you have to find a rental because you haven't quite found a new home first. So take that into consideration. Even ask the question to your parents or friends or family if you could temporarily move in and move that around.
So the second option is buying first and selling after. Now, the thing you need to consider with this option is if you have enough equity in your home, because you are going to be reliant on releasing that equity to cover your deposits and required expenses. One thing also to keep in mind is if there isn't enough equity in the property, then you could be up for costs such as mortgage insurance, and that's something you need to factor in when doing your calculation. Also, when you buy first, you're going to have your existing property there. So you need to be able to afford the repayments of both the new property and the existing property, especially if you're not planning on renting out the existing property anytime soon.
I think the big advantage of buying first is that it puts you in the control seat when it comes to selling your home. If, for example, you've bought a new home, you've negotiated a longer settlement, so you might say, oh, I'm going to settle in 90 days in 3 months' time. It gives you 3 months potentially to sell your current home. Then, because you bought first, you know the date of when your new home settles. So it's going to be 90 days. When you get a contract on someone coming along and say, yep, Nathan, I want to buy your home. I'm going to give you all this money. I'm going to move in 30 days. You say, no. It has to be 90 because I want everything to line up and settle on the same day. We'll talk about simultaneous settlement in a bit more detail later on in the video.
So typically this second option of buying the home first requires you to have a bit more equity, because as I said before, if you don't have enough equity in your existing home, you're going to have things like mortgage insurance. So if you are considering it, you definitely want to make sure that you're not really owing more than 60 to 70% on the value of the property with your existing mortgage at the moment. I guess the major advantage here is you're not going to have to move into a rental property in the short term. So a big upside here is you can buy the home that you're really after. You can take your time because there's no time pressures between when you've got your existing property sold and buying the next one, and you can move straight in.
In this scenario where you buy first, you need to be in a pretty strong financial position because you're potentially supporting 2 mortgages, your existing home before you sell it and the new home once you move in. So make sure your mortgage broker runs the numbers and you get comfortable, because like Nathan said a bit earlier, you might not be renting your old home. You might be trying to sell it and there could be a month, 2 months, 3 months before it sells that you can't really rent it out and you can't get tenants in there. So you're gonna be paying 2 mortgages.
Now, the third option, which is kind of related to buying first, is using a guarantor. So if you have mum or dad that can help and you don't quite have enough equity in your property and you don't want to pay mortgage insurance, you can consider getting mum or dad to go guarantor on your property. Now, once again, if you are planning on selling your existing property in the short term, you can use a parental guarantor in the medium term to help get in that property. And then once you've sold your existing home, you can pay down the debt and remove the guarantors. This is another good option if you don't have enough equity in your property. And if mum and dad are happy to help and understand that it could be a short-term solution, it could be a win-win.
There are lots of risks with guarantor loans, so definitely speak to your mortgage broker. Some banks will only do guarantor loans for your first home, not a second and not an investment property. So chat to your broker, because like I said, there are lots of complications here getting your parents involved, even if they're retired, not working, there's way more restrictions. So probably chat to your broker, because this is generally the least preferred option for a lot of people.
We talked about simultaneous settlement before, and now we want to go into a bit more details around it. I guess the main thing about simultaneous settlement is that your purchase and your existing property you're selling settle on the same day.
The obvious advantage to this is you're not having to pay for two mortgages. Your old house sells, new house settles, and the money goes from one to the other, and it seems really elegant. It seems like the right solution, but there can be complications.
Now, it sounds really good in theory, but it is extremely difficult to orchestrate. Firstly, you've got to sell your property and buy the property and ensure they settle on the same day. Now, this in itself is a very difficult thing to manage. I know Jaden mentioned earlier, you can look at buying a property and having an extended settlement. And whilst you're going through the process of getting your loan approvals for the purchase, you also have your property being sold on the background and lining up the sale date of your existing property to happen at the same time as your purchase.
Now, it's tricky for a couple of reasons. Number one is the deposit when you're buying a new home. So when you sign a contract on a new home to buy, you might need to put down an initial deposit, sometimes say $1,000, then a balance deposit. Sometimes this is between 5 to 10% of the purchase price. But it gets complicated because all your deposit is coming from the sale of your home, which isn't going to happen for 90 days. So what can you do? The first thing you can do is renegotiate with the agent. See if you can reduce the deposit amount on the balance deposit instead of being 5% to whatever you've got on hand, because those funds aren't going to be available until you sell your home. The second thing is borrow some money from mum, dad, friends, family for that balance deposit, because again, you're not going to have it until your home sells, and that money's not going to actually hit your account until that day. Third option is looking at a deposit bond. Now, this is something that used to be really common when you didn't actually have the deposit funds. It's a third party that pretty much says, yep, I guarantee that Nathan's good for the 5% deposit that'll be paid when you sell your property. It does cost money for a deposit bond, and you do need to ask the real estate agent and the sellers for consent to use it, but it can be a good solution in the case that you don't actually have the cold hard deposit cash in your account today. How does finance work with a simultaneous settlement? So in the case where you might have bought first, not quite sold your place, how's the bank going to assess your application? With a number of banks, they can actually make it a settlement condition that your current home sells on or before you move into the new home. So in other words, the bank's saying, Nathan, you need to sell your family home before or on the same day that you buy the new home. That way, the deposit funds, your 20%, 30%, your 10% deposit become available, they get put in the account, and that goes towards the deposit of your new home.
Now, the risk here with this clause is you can actually buy a property without putting any clauses in the purchase contract saying that your purchase is subject to your existing property selling. Now, this is usually an advantage to getting the contract over the line.
So when you're financing, you might make an offer that's subject to say 14 days for finance. The bank will approve your loan and put a condition on your finance approval to say that your existing home must settle simultaneously at the same time as the new home. Now, there can be a risk here because if you can't sell your house in that time, everything can fall over.
So one thing to be careful of here is when you're making offers on purchasing a property, typically you might want to put in a sunset clause, which is recommended, and your solicitor will always recommend doing this. The sunset clause protects you and says that your purchase is subject to your existing property settling. The thing we're seeing more and more recently, which is quite troubling, is that buyers are waiving their sunset clause. So they're going in to purchase a property and saying, we don't have any conditions or any requirements for us to sell our existing home. They're relying on the bank's approval and settlement condition to say, you've got to sell your property before we give you your funds, and then running the gauntlet to make sure that they sell their property on or before the purchase happens. One thing to be careful here is if you don't sell your property prior to your purchase happening, the bank will not fund you the loan. So it is a risk and one you should take very seriously.
So how can I settle simultaneously? I've got an example of some customers we've helped with doing this week. The couple, Josh and Sarah, have owned their existing home for the last 4 years. They've built up a bunch of equity, but only have about 20% in there, so it's not going to be suitable for a bridging loan. They went out this week and found a perfect home for $1.2 million. So they decided that they wanted to buy first and then try and sell their house quickly. They spoke to a real estate agent. The agent said, yep, I can definitely sell your house in about 45 days. Josh and Sarah went out, made an offer on the new house, subject to 70 days settlement. So this gives them 70 days to quickly sell their house and try and get the timeframes to line up. We got their new home loan approved for the new house, which is subject to that 70-day settlement, and the condition that says their existing home must settle simultaneously on or before that 70-day period. So Josh and Sarah have 70 days to sell their existing property. The good thing is, once their existing property is under contract, maybe it'll be under contract in 30 or 40 days, they can try and bring forward the settlement of their new home to happen all at the same time. In general, it's much easier to bring forward a settlement date than to push it back, because then you can potentially risk the contract. Chat to your solicitor, chat to your broker. This is something that we do see a lot of at the moment. So if you do need help with simultaneous settlement, Hunter Galloway, we're mortgage brokers. We help buyers across Australia. We'd love to help you out.
Alrighty, and the last option here is bridging finance. Now, bridging also allows you to buy the property first and sell the existing property at a later date. You actually have up to 12 months to sell the existing property. The good thing with bridging finance is that you actually don't make any repayments on the bridged amount for the bridging period, depending on the bank. So what that means for you is you can actually have the repayments capitalized or be added on top of the existing loan during the time that you're looking to sell. So there's not so much of a financial burden.
Now, the downside is you do pay higher interest rates on bridging loans. And the biggest issue is for buyers that have bought in the last 2-3 years and looking at upgrading is with a bridging loan, you need to have at least 60% equity or more in your home. So if you've only got sort of 20 or 30%, it's pretty unlikely bridging is going to work in your situation. Like Nathan said as well, with bridging, you generally need a pretty good income to be able to support it if your bank doesn't add the repayments to the loan. The other downside, like Nathan mentioned, is with bridging, you have to sell within 6 to 12 months. So if you're in a slow market, maybe in a regional area, and it's going to take longer than that, or it's a unique property, this is a real risk you need to consider, because if you don't sell in that time, the bank considers you in default.
So like Jaden just said, some banks actually assess your income to see if you can afford the bridging during the bridging period. There are other banks that don't do any assessments on your income and only look at your ability to service the loan once you've paid out all the debt associated with the sale. So they call that the end debt. So for example, if you have an existing property worth $1 million and there's $500,000 on that, and then you have a new purchase worth $1 million and you need to borrow the full amount, $1 million, you have a total pooled amount of borrowings of 1.5. You'd have your total house valued of $2 million. And when you sell the existing property for $1 million, you'd actually pay down the loan by $1 million and you'd be left over with the $500,000. Obviously it might be a bit high because there's going to be other costs, but some banks actually do the assessment on the end debt, which can actually help if you are struggling to get your borrowing ability up for a total peak debt. Once again, it depends on the lenders. Some lenders do the assessment on the peak debt, others do the assessment on the end debt. So there can be a big difference in outcome when you are looking at this. And one of the things to remember with bridging is they are highly complicated. And typically, in our own experience, is that banks can make some errors. And if you're trying to get a settlement done in 30 days, it can be a real push. So if you are doing bridging, that's where you want to give yourself at least a 60-day period for the banks to do all their background checks, assessments, and have a few more things moving on in the background, given the complexity of the bridging.
Another thing to note is with bridging loan, it all has to be with the one bank. So if you are banking with a smaller bank, for example, that doesn't do bridging loans, in that 30 or 60 days, you actually have to refinance your home loan for the new bank to use the equity that'll do the bridging loan. They'll also take a mortgage over the new house and move things around. So just be wary of that, because refinancing, sometimes you might need 6 or 7 weeks. And like Nathan said, there can be complexities there that can cause issues with your new home.
So have you ever purchased a property first and sold later? Or have you purchased and hang on to your property for the long term? Leave a comment below. We'd love to know your story. Did you know here at Hunter Galloway, we're mortgage brokers and help home buyers right across Australia. So if you're a home buyer and needing assistance with finance, call us on 1300 088 065 or visit us at huntergalloway.com.au. We'd love to help and have a chat. Give us a call today. Jaden and I will be able to assist you. And thanks for watching. We'll see you next time.